Hey everyone, I actually just landed at the airport right now, so I've had like no sleep, so I'm kind of just winging it right now. But hey everyone, this should be a pretty exciting panel. Like stablecoins are like literally one of the most important things in DeFi lending. So I'm really excited to have all the panelists introduce themselves, their projects. As for me, my name is Walter. I'm a data science lead at Gauntlet. We're a crypto economic research firm. Hoping to use off-chain intelligence to drive on-chain efficiency. We'll start with Michael.
Howdy, everyone. My name is Michael Lewellen. Even though I've got a Compound shirt, I actually work at Open Zeppelin. But Open Zeppelin's been doing a lot of work with Compound over the last couple of years as security partners. There's kind of like I'm basically kind of in a primary security advisory position, but also end up playing a lot of roles in the protocol where security has some relation, which is nearly everywhere. So yeah, excited to talk more about like what Compound's been up to in Open Zeppelin and everything else.
I'm Paul from Does that work? And now? Yes. Okay. Hi everyone. So I'm Paul from Morpho Labs. Co-founded the Morpho protocol 2.5 years ago, and today we're building lending and borrowing primitive on Ethereum and on Base.
Yeah, hi everyone. My name is Emilio. I work at Avara. I am VP of engineering. I handle everything that is DeFi related with Avara and Aave Labs.
Hello everybody, I'm Sam, CEO of Phoenix Labs, and we work on Spark protocol, which is essentially liquidity provisioning for MakerDAO. So DAI is the largest decentralized stablecoin. We work to issue loans.
Cool, okay. So I guess for the first question, we're gonna start with Sam. There's a lot of new different collateral types coming up in DeFi. Which ones do you see are the most conducive for stablecoin borrowing? What are the mechanisms that can support it? How do you think this will go? How do you think this will look going forward?
Yeah, sure. So historically, the biggest use case we've had for lending stablecoins has been speculative leverage on specifically at scale the assets of ETH and Bitcoin. So this has been, it still is the most dominant use case by far. So really, once you get beyond that, I think we're kind of maxing that out with access to centralized exchanges products like Athena tokenizing this. With the cash and carry trade, we kind of have this capacity of, on the order of, $10 to $100 billion worth of leverage there, or worth of loans available for stablecoins within crypto. So where do you go from there? Like, I mean, there's only one place. It's real-world assets. It's TradFi. You need to get up to this next couple orders of magnitude of scale. We need to keep onboarding RWA. So the first big example of this we've seen over the past year or so, due to the interest rate environment changing, is the tokenization of treasury bill products. So this is kind of the low-hanging fruit. And so Maker has been the biggest buyer in DeFi of this, like sort of spearheading this project where I think at the beginning of 2023, it really started to ramp up, and Maker peaked at about $2 billion in exposure to treasury bills. Now, it wasn't tokenized, so you see the market for the tokenized T-bills growing at about the same rate. So that's about $1 billion right now. Maker is about $1 billion of this as well. And so this has been a big growth sector. And what I want to see in the future is more and more of these real-world assets tokenized on-chain, such that we can start issuing loans for other use cases other than crypto speculation. Because as much as people love this use case right now, speculation is not going to fuel the industry forever. We need to mature eventually, and so we need to find more regular real-world use cases for issuing loans.
Well, let's go left to right.
Yeah, personally, I think it depends on what degree of. I mean, there are different degrees of liberty, if we want to call like that, in stablecoin design. So RWA brings something that is certainly, from a futuristic perspective, like very important because it's probably the next frontier in terms of bringing new capital, new value to DeFi. But also there is the aspect of decentralization. So if we are talking specifically about collaterals, I would say that the purest collateral from a decentralization perspective that we can use is probably on the Ethereum network is ETH, in the sense that like it's the lowest risk, highest, most decentralized assets that you can probably use as collateral. And then from there, it's like a kind of a curve where we have risk and centralization, different risk and centralization of setups. And so LSTs have a different risk profile, different decentralization and centralization profile, but they also bring different characteristics. So there is native yield brought by the usage of the network. Then we have assets like wrapped bitcoins, which we can probably say is kind of an RWA, right? In the sense that it's a tokenized asset, still coming from still a digital asset, but coming from another network. So there is kind of intermediate step there that brings another degree of centralization. And towards the centralization scale, there are RWAs, because inevitably when you start moving towards the real world, you need to have some compromises in terms of degrees of decentralization, but that is right. I do believe that probably I'm more and more convinced that probably a fully decentralized stablecoin is probably impossible to scale. I'm not completely sure, but I kind of think that we are heading towards that way. But even introducing some degrees of centralization that is differentiated enough, those in my view are also ways to decentralize. When we talk about decentralization, we talk about custody risk, we talk about liquidity risk and many other aspects. So having different ways of integrating more assets that are more centralized on the decentralization scale is also a way to decentralize risk, right? So I agree with him that probably RWAs are the future in terms of bringing the next wave of large capital inflows into DeFi, into blockchain. And I also think that decentralized assets with the different degrees of decentralization will still have a very strong presence.
Yeah, I mean, I agree. I think this is inevitable that we'll come back to like more and more like centralized assets, but at the same time, those centralized assets will have more and more like decentralized token issuances, etc. I think the decentralization of stablecoins will mostly be in the governance processes of the DAO that is issuing the loans, right? Like how the backing of the stablecoin in itself, who's choosing that backing, and I think inherently like the decentralization will come from those processes. So there is like innovative like mechanisms and designs around that. Like Maker Endgame is one of them. But yeah, I very much agree that we're kind of not seeing the limit, but approaching the limits of what like the speculative use case can bring in terms of adoption.
Yeah, I just want to comment on the decentralized stablecoin. So like this is something that's been ongoing for a while now, this thinking you can make a decentralized stablecoin. Now, I mean, what does that mean in practice? It means you're backing it by only ETH, because like really there's multi-sigs like everywhere else once you get outside of that. So this has been tried, and like you can definitely make it at a small scale, but it's like a scalable decentralized stablecoin is that specifically pegged to the US dollar is completely a myth. So Seb's presentation at the beginning was very good, if you missed it, talking about the hierarchy of money. And so the only way you can scale up something lower in that hierarchy is if you back it directly by something that's higher up in the hierarchy of money. So for DAI, this is the backing with USDC. And any stablecoin project that launches and starts scaling up to billions, there is a limit there. And so like, I think if you really tap out, as I said before, if you tap out like the DeFi lending against ETH. You can't even really tap into centralized exchange markets because then you've got all kinds of custodians and stuff like that. So really the market for leverage against ETH will not scale to beyond a couple billion at most. So right then and there, you've hit a fundamental blocker. So a truly decentralized stablecoin that's scalable is a myth, frankly. So you have to back it by things that are higher up in the hierarchy of money.
Yeah, I mean, I agree with everything that everyone said here. I think I'd just add that the biggest risk going forward is going to be if decentralization is going to be a key part of the use case for using a stablecoin, like are you segregating that from the stablecoins that are going to have to scale more with real-world assets? It's kind of like the things you see with Rye and others that are kind of experimenting with keeping it pure, which takes a big trade-off on like the stable part of the stablecoin. But I think at the end of the day, are the people that are making big use of these stablecoins aware of that, aware of how it's being mixed? And that's one thing that with Compound, there's a lot of segregated markets now in the new version of the protocol. So it's something that you think about a lot. How much can we segregate liquidity before it becomes less valuable, but is worth the risk management trade-off? These are like very hard questions to answer, but it's something we constantly think about.
Cool. The natural next question then is, given all these new types of collaterals, whether it's RWAs, whether it's the next generation of ETH derivatives, the current borrowing mechanisms in lending are, they're fairly like dynamic based, right? Like the borrowing rates are pretty dynamic based on utilization. Are there other types of borrowing mechanisms that might work? For instance, we can consider like, fixed time loans, for instance. What does the equilibrium look like this down the road for these different types of mechanisms for borrowing? We can start with Paul.
Yeah, so I think fixed rate lending, as we describe it in like DeFi, has been particularly challenging because of like the terms, and you have to, essentially what's challenging in lending is like bringing together the lenders and the borrowers at the right time. And decentralized monolithic lending and borrowing pools are exceptional at this. Like they're going to bring together lenders and borrowers at all time at the same place. When you introduce terms, well, you fragment a lot, right? Because you need to find people that agree on this specific term. And currently, like the user persona of DeFi, is probably more and more inclined to that and more active. But passive lenders are fairly passive, like large lenders, etc. So it's hasn't been such a success so far. However, it is, you could, like if you look at traditional finance, a lot of things are based on like short-term loans, and variable interest rates are more rebuilt on top of like the fixed rate primitive. So in DeFi, like the primitive is more like the interest rate model that was like, continuous interest rates, while in traditional finance, you have like fixed term. And the market is pricing like the zero coupon, and rates get defined by the markets, not by like governance, right? And overall, I think there is a reason why we ended up like doing interest rate models and continuous and variable interest rates. It's really like liquidity and being able to meet like supply and demand at the same time. But as users complexify, and this is the case more and more in DeFi, as you have like proxies that are between the base protocol and the users that are able to bring like cleverness and are like some kind of proxy for activity on behalf of the user, you can imagine that those kinds of interest rate models will come back like in the coming years. And I think we have a presentation by Liquidity on borrowers defining their rates right after. I'm not sure. But.
I can go. Yeah, so I mean, you guys have been in the market. Like right now, there's just no demand for long-dated fixed rate stuff. It's because like the market is nuts. Like it's up. 3 months ago, we were in like a bull market, and now it's like everything's over, right? So like, who's taking loans at a 6-month duration? So this is just, there's just no demand for it right now. But I think obviously the demand will come in once the market matures. So I think it's just a matter of time until fixed rate stuff becomes more popular. I mean, we look at this stuff quite frequently at Maker for like as a new market for loans. But yeah, I mean, once you even 3 months is like you're really kind of pushing the demand there. So yeah, I think this is something just going to come in over the long run. But right now, there's just the demand isn't there in DeFi.
It's also to reconnect to the previous question. I think it's also a matter of the collaterals that people are using and the volatility connected to those collaterals. So what Sam was mentioning is that like the volatility of the market that we have at the moment is just is insane. But once we start bringing assets that are more stable, so for example, we start tokenizing houses, that's a different behavior, right? So people collateralizing a house usually have long-term plans, right? So they are looking for a different kind. In fact, we have mortgages that are structured in a fixed rate way, in a variable rate way. There are a variety of instruments there. And it's also related to what kind of collaterals people are going to use. With crypto inherently, I mean, we tried to do fixed rate borrowing a couple of times. We tried with Itland in 2017, and that taught us important lessons on that because back in the days in 2017, Itland was like generating like 50 million volume in loans, which was crazy by the time because there were no stable coins. I don't know, Icon and EOS and all of those were ERC20s on Ethereum. So we are talking like really a long time ago in crypto terms. And yet, one behavior that we observed is that once Compound came out, back in the days, Compound 1, Itland was basically obsolete from day one. And the reason was that kind of what Paul was mentioning before, that lenders are kind of lazy from a certain perspective, but also borrowers that are, I think, the most important part of the economics of lending and borrowing, because those are those who generate demand. Usually, what we observed when we had Itland, when Compound was there, that even if on Itland there were possibilities of borrowing at better rates than Compound, but you had to match lender and borrowers, people was actually still going to Compound, you know, because users wanted, borrowers especially, maybe they want to capture the occasion to go long instantaneously. They don't want to wait 3 days until a lender comes to provision liquidity, and maybe the market went up 50% in the meantime, you know. So I do think that fixed rate borrowing and lending probably, if it's going to take any traction in crypto, is going to be some time along the line, and probably will be easier with different types of collaterals as well.
I think the only thing I'd add is it's a naive question, but I'm just curious to know, like, how many people in the traditional finance world, if they had the functions that we have today with like these variable interest rates, would prefer that over fixed rate, whereas right now they would prefer fixed rate because that's what they're familiar with, it's what they built their whole financial processes over. I think there's definitely still a lot of use cases for fixed rate, like mortgages being a perfect example. You don't, want to deal with a mortgage rate that's going to change over the years, but I would be very curious to see. We obviously saw a lot of issues with banks that were locked into long-term fixed rates and treasuries that created an issue for the banking sector, or that just happened to get sucked into crypto because of the choke point narrative. But I would just, that's my naive question as someone who doesn't understand entirely what that mentality might be.
Cool. Obviously, we talked about a lot of different collaterals, different types of borrowing mechanisms. One of the hot things in crypto these days is the idea of interoperability and the Cosmos ecosystem and the many chain thesis. What does the future of cross-chain lending look like? What are some of the technical considerations, some of the economic considerations? How does the space continue to grow? Let's start with Michael.
Yeah, this is something we've gotten a lot of experience with because Open Zeppelin's been working with Compound, it launched a lot of deployments. We've obviously been very much like scrutinizing like new markets, EVM equivalents, but like looking at it, I guess, from a financial perspective, it's going to be interesting because you obviously have a lot more potential demand on other chains, but then you're also segregating your liquidity. Now, Compound's kind of a specific example where they kind of decided that segregated markets are fine. Like that's basically the idea. You're going to have one base asset for each market and then a certain number of collaterals, and you could have multiple of those on the same chain. So you're already potentially segregating liquidity on one chain, and you're taking that you're eating that might be like less features available, but like more optimized for the specific feature that you've kind of decided on, which is like borrowing a stable or ETH. So when you're going across different chains, I think you're gonna see more segregated liquidity, and then you're probably gonna see. We've already seen several people building this on Compound. People try to build aggregators on top that will, you're not going to get the same level of base security you might get with just using the vanilla protocol, but you could have more of the functionality of like moving liquidity between multiple chains, but you're going to have bridge providers you're going to have to trust. You're going to have to trust the people implementing the smart contracts on top. And like, I think that's going to be an interesting role to see play out, because I think it's going to be necessary if we don't want to like segregate liquidity too much, but we're also going to obviously be very careful about the risks there.
Yeah, I don't really view liquidity fragmentation as big of an issue in practice as it's being made out to right now. Right now we're in this like infrastructure phase where just like in the abstract things are being built out on all these different chains. But when you're talking about like what the applications that people are actually using on top of this, specifically like lending and DEXs, really, well, for lending at least, the main, or actually is for DEXs as well, the main thing that you care about is US dollar stablecoin liquidity. That's what liquidity is. So like, what an issue, so as an issuer, Maker is able to, unlike a full reserve stablecoin like USDC, Maker can do just-in-time issuance on all of these chains at the time. So DAI can be, you call it pre-minted, whatever you want to call it. Capacity can be allocated to basically every DeFi protocol on all the chains at once. And then the actual liquidity to facilitate the backing of this of DAI on these chains can be consolidated into a back-end infrastructure. So for DAI, we use USDC as for peg liquidity because it's higher up on the hierarchy of money. So as Maker keeps 25% cash reserves at all times to back the DAI stablecoin to ensure that you have high liquidity with USDC. Maker can then move USDC to all these different chains as a sort of a backing instrument for the peg on these chains, issue DAI on all these different protocols all at once, and so then liquidity is no longer a concern. The users can just use or mint DAI. They have the USDC liquidity there, and Circle has fairly good redemption process on all these big chains now. So really, in practice, this whole thing is going to be very, very seamless process for the end user. And so, like, we don't have to worry about market makers facilitating this. On the U.S. dollar side, you have, I guess you call them stablecoins. There's all these terms, but whatever. Decentralized stablecoin. I'll go with the classic one, where it's not a full reserve stablecoin, and specifically yield-bearing versions of this, like SDAI. They'll facilitate the back-end infrastructure of this. And you have the same thing with ETH, with LSTs. Issuers can do this all around on all the chains. So really, I think this is more of a theoretical problem. For the assets that we care about, ETH and US dollars, it's not going to be a problem in practice in the next little while.
Yeah, and I would add to this that I think there is the general concern about liquidity fragmentation, whether it's about like cross-chain or risk management, etc. But in practice, aggregation and just-in-time liquidity is extremely powerful from a user standpoint, because at the end of the day, liquidity is about like getting the tokens you want at the moment you want them. And if you have someone that abstracts away like the bridging at the moment, like you're taking your loan, for example, that's perfectly fine. And maybe we'll disagree on this, I don't know, but I feel like in lending, at least there is like two views. One is that cross-chain should be enshrined in the protocol, and that cross-chain should be externalized and brought like just in time when the user needs it. Our perspective on this is that, so at Morpho, we have a primitive lending and borrowing protocol that externalizes completely like risk management considerations, right? And so users have to do their own risk management. And we believe that's the same thing for bridges. Like selecting a bridge in itself is extremely, like it's non-trivial. And there are trade-offs like pretty much all the time. And we believe it should remain, the decision of the user to choose, how they get this liquidity. And then it's their choice, to have like abstraction layers and decide to, use a solution that is going to reaggregate and that's going to do all the hard work for them. But I think at the primitive level, for the sake of resiliency, you should not enshrine like cross-chain in the lending protocols.
In reality, at Aave, we have been exploring. What we are noticing is that, of course, Aave, for example, is deployed like on, I think, on 13 chains. So it's probably the largest protocol in terms of number of chains in which it has been deployed. And the behavior of the users from a market, from the Ethereum market to the Arbitrum market to the base market, whatever, doesn't really change much in terms of the way they use the protocol. But of course, the proportions in which the liquidity is being used in the protocol are different. So I do agree that the just-in-time liquidity primitive is quite strong in terms of narrative, because it allows you, we are exploring something like this with Go, which is our native stablecoin. We just went multi-chain, we developed and deployed an infrastructure for canonical Go across. For now it's on Ethereum and Arbitrum, but in the future it's going to be extended to all the networks where Aave is supported. And of course, the next step is going to be develop an infrastructure for just-in-time liquidity there as well, where you can use the infrastructure that we just built to move liquidity across the different networks by just generating it. But this use case is very powerful, but it's also related to how much traction the stablecoin that you're using has. So, for example, DAI has a lot of traction, and for them it's much easier to apply this kind of strategy because you can go and capture use cases everywhere with DAI because it's pretty much used across the board on all the networks. I think it's Aave, for example, lists DAI in pretty much all the networks where it's deployed, I think, something like that. So with a stablecoin like DAI that has already kind of reached critical mass, at least in crypto proportions. So I mean, the crypto market is relatively small. So DAI is quite big in terms of the proportions of the crypto market. It's much easier to apply a strategy like this compared to Go, that is in a growth phase, so it's still relatively small. And at the other end of the spectrum, there are stablecoins that don't actually use this kind of strategy. For example, USDC, which is generated whenever a user goes to Circle and asks to receive USDC in exchange for dollars. And because of that, like, users then are individually deciding where these dollars will be, crypto dollars will be used. So they might be using them on Base, they might be using them on Ethereum, they might be using them on Arbitrum. And we do see value in being able to move this kind of liquidity whenever there is an excess on a net. I mean, what we have noticed is that there is not necessarily arbitrage, if we want to call this way, between the networks. So some network might sit on a lot of liquidity, another network might have been kind of a demand in a liquidity crunch, so there is a demand. We have noticed that in multiple cases it would have been useful to be able to move liquidity from one network where there is excess to another network where there is demand transparently for the users. But this also has an implication in terms of risk, because it changes the risk assumptions of every market. So if you, for example, move, I don't know, 50 million out of the Ethereum market to Base, then you are exposing the Ethereum market and the USDC suppliers in the Ethereum market to 50 million. I mean, you are bringing 50 million of exposure to the Base network to Ethereum suppliers, which of course has risk implications for the bridge, for the technology, everything. So it's something that we certainly want to explore, and we are kind of moving on both directions on Aave. So I do think that with V4 especially, there will be ways to experiment on that front.
Cool. Obviously, lending market performance in general is very dependent on overall market downturns, market upturns. So naturally, market downturns do present a lot of risk in terms of like borrowing health, et cetera, for users. In our quest to scale decentralized lending, naturally, and improve the capital efficiency, naturally, at times, lending protocols might incur bad debt, whether we like it or not. Is it necessary to enshrine an insurance layer in lending protocols? If so, what's the best way to do it? We can start with Emilio.
It's not necessary, I would say. It kind of depends on what kind of spin you want to give to the protocol that you're building. So, for example, Morpho relies on the idea that the user is completely responsible for any action it takes. So, if a Metamorpho vault or a Morpho blue market goes underwater because there was risk, and the risk was not properly managed, that's user responsibility, right?
For Morpho Blue, not Metamorpho. So the way Morpho Blue is designed is like bad debt is realized to users. So correct me if I'm wrong on Aave. Like essentially, bad debt is not directly accounted. It's here, but users don't take the loss. It's only the last user to withdraw that will not be able to withdraw because there is a loss in the protocol. And so Aave has put a lot of mechanisms in place to avoid like bank run scenarios. Like on top of like all the risk management that is done, there is like this insurance fund of Aave tokens that if something bad happens to the protocol, while Aave token holders can vote to sell Aave tokens in order to repay the bad debt. In Morpho, if the bad debt happens, it gets realized. So users of a given market are going to take the loss immediately proportionally to their share of the market at the Morpho Blue level. Then at the Metamorpho level, Metamorpho votes, so the risk curation layer, well, risk creators can decide to put in place their insurance. Like they're free, like they collect some fees. If they want to put an insurance in place, they are free to do. We don't have an opinion on the way they do it or the way they design it, etc., etc. So yeah, that was just to elaborate.
But if a Morpho Blue market incurs in losses and a Metamorpho vault is supplying liquidity to that Morpho Blue market, the Metamorpho is incurring in losses as well.
Yes, but then they can put in place like insurance funds and they can treat it differently.
Okay, yeah, for sure.
Yeah, I can talk about a specific, so we're using Metamorpho. We have Metamorpho vaults as Spark as an extension of MakerDAO, and there is an insurance buffer in place. So Maker has 50 million in cash that it holds as an insurance buffer. And on top of that, it holds 150 million in protocol-owned liquidity in Uniswap and Maker DAI pool. So these are, I would say, like Morpho is just kind of like a tool. You can construct whatever you want with it. So we've, in the same way that the Maker Core Vaults have this insurance buffer for DAI holders are designed to sit very, very senior to a lot of this lending that happens. And so you can construct pretty arbitrary constructions here. So yeah.
Okay, but like my point was, it's not built into the, so you guys decide to put an insurance fund, but
yes.
By default there is no insurance fund. This is what I meant.
Yes,
right?
yes. There is no global insurance funds.
So it's kind of a different approach there. So the insurance fund, in case of Aave, where the risk management is DAO controlled, the decision was to integrate an automated insurance mechanism over there. It kind of partially, it's kind of embedded partially because like any fee that the Aave market earns is retained within the Aave protocol. So if there is a loss, for example, the Aave protocol is automatically absorbing it for the amount of liquidity that is supplied from the treasury there, because if there is a loss, users are allowed to withdraw while the treasury is DAO controlled. And also there is a safety module that is built with a variety of currencies that will be used, that are used in general to, they have never been used until now, but potentially can be used for ensuring that suppliers are not incurring in losses for the maximum capability of the safety module. So I would not say it needs to be, it's kind of depends on the spin that you want to give in terms of narrative that you want to give to the protocol. I kind of agree with the idea that probably a fully trustless and permissionless primitive like Morpho Blue would not embed such a mechanism in the first place. I do also think that the nature of Morpho, I mean, what I have been seeing is that this kind of approach is trying to emulate what DEXs do with lending, right? Basically, so I mean, the design behind Morpho is kind of a similar approach to a DEX pool, where the users provide liquidity and it's completely immutable. There is no risk management and so on and so forth. I do think that the use case for lending and borrowing is massively different from swapping or liquidity provisioning in a DEX. So I do, personally, I would prefer using a protocol that has, you know, built-in insurance fund. But again, I do think it depends on a variety of aspects. It's certainly not mandatory.
Yeah, I'd like to add two things on this. So first, I agree with you. Like, as a passive user, I would never use like Morpho Blue directly. Like, I would definitely use like those abstractions layers that are built on top and build like, you know, that have a specific risk profile for me or a specific insurance funds that suit my needs. I would also wanted to add on the bad debt question that I think we've lived with the idea that DeFi lending should be risk-free in some sense, and that's not really the case. Like, eventually we'll have like losses, and you can, you know, there is some part of the risk profile where, yes, if you decide to take a lot more risk, you'll have a much higher APY, and yes, from time to time you'll have bad debt, which will lower your APY, but maybe it's a good trade at the end of the day. And I think a great example of this is actually the Gauntlet vaults that are built on Morpho, where you have different categories of risk. You have like the prime vaults from Gauntlet on Morpho, which are like incredibly like secure collateral with like just BTC and STEs, I think. And then you have like the core vaults, which accept more long tail collateral, etc. And so you have different vaults with different risk profiles and different risk appetites. And obviously the ones with the highest, you know, risk will have the highest rate, and sometimes to times will incur some bad debt, but will often be compensated by just the high yielding interest rates. And I think it's important as an industry that we sort of like stop thinking about investment opportunities as completely risk-free, because when we talk to users, this is really how they tend to think. And you know, everything has a trade-off. So, you know, I anticipate that as the ecosystem mature, like those risk-reward like profiles will be more easily expressed, and you'll have like products that suit all of them in DeFi, essentially.
I mean, Compound has protocol reserves, which I assume would essentially function the way we're talking about insurance here. And yeah, the idea is if there's any bad debt, that can be absorbed by the protocol. And it comes down to like what you as a protocol are trying to tell users that you're achieving. If you're trying to say that we're going to provide you as risk-free an experience as possible, there is still risk, but we're going to try to cover for like black swan events, for sudden price movements, for sudden Oracle failures, for anything that might come up that just wasn't considered, even if the risk parameters are set perfectly, like other things can always happen. So I think it's useful to have that to step in, and with Compound, I definitely have a preference for it, but like I would also say, like if you're trying to strip out less, if you want to give more of the risk management to the user to choose what they want to be a part of, then it does make sense to then say, okay, well, maybe the insurance function there is not a critical piece. So yeah, it comes down to kind of like how you're putting that stack together. I'm more comfortable with Compound having that feature and knowing that it's not up to governance to figure out how to maybe deal with a bad debt scenario. It just happens automatically. But I could definitely see other protocols wanting to put it together differently.
Cool. One last big question for the group. Few lending protocols these days have created their own stablecoin or are deeply intertwined with a particular stablecoin. What are some of the challenges associated with this? What are some of the dynamics associated with this? In the end, will every single money marketplace have their own stablecoin? What do you guys think?
So just so we don't at Morpho, and we don't plan to. We see decentralized lending, as like the. So I know it's like, the stablecoin industry has been like pretty attractive and like its, potential and also a financial potential for projects. We believe lending is a smaller opportunity than stablecoins, but we're fine with that. And I think like building the decentralized lending infrastructure that will allow stablecoins to operate there, the best possible way is our mission. And we don't plan on launching stablecoins, just providing like the tools for stablecoin operators, which I believe fundamentally are about, issuing loans the correct way, not about like building the lending infrastructure. Those are two different, in my opinion, again, two different like businesses. Essentially.
Yeah. So let's break stablecoins into two different types. Like so, there's like the full reserve, which are like the Circle, Tether, Mountain, these types of stablecoins, which are very, very strict. Collateral set, which basically they're just doing one-to-one with treasury bills. Once you get into the fractional reserve stablecoins within DeFi, I think this and lending is just going to be the same thing in the long run. So like we're already seeing this converge. SDAI specifically, the yield-bearing version of DAI, and AUSDC are pretty much the same thing. And so as newer stablecoins, we see a lot of experimentation, but once you hit that scaling, you really want to just, you follow the same path. You don't have really a lot of options you can explore. And lending and stablecoins, these are kind of two different names we've given for what is essentially the same thing, which is, the era of having zero yielding stablecoins is over. So Tether has won that, at least unless something fundamentally changes. Any stablecoin that launches now, if you want to compete, you have to be a yield-bearing stablecoin. And this looks more and more like just general lending within DeFi. So yeah, I think a lot of these terms we come up with, this all just kind of, it's all just the same thing dressed up differently.
It's just a matter of who the lender is in this case. Because like, we have issuers, we have lenders. In the case of Maker, we have an entity that is also, this is both issuer and lender at the same time, because they issue the stablecoin and they also have mechanism to automatically perform liquidity provisioning in a variety of protocols. And once you have that, then at that point, I agree with Sam, it's basically the same thing. But the profile in terms of, for example, revenue for the issuer are massively different. So for the Aave protocol, for example, to give an idea of what I'm talking about, Go is at the moment has a total supply, I think, of 85 million or more or less. And it's already generating revenue which is basically equal to the total reserve of USDC on the Ethereum market, which I'm talking about revenue. I'm not talking about profit, because I saw you were already raising the microphone. Let me anticipate the guy. I know that the stablecoin business is really hard business, especially when we talk about decentralized stablecoin. So the revenue for stablecoins is very high, but reaching critical mass is tricky. It's not trivial, and it takes considerable investment. In terms of Go, we are pretty much on par in terms of investment that the DAO is doing at the moment. So there is a relatively small delta that the DAO is paying to propel the growth of Go, but it's negative. So of course, although the revenue numbers are very nice, the profit at the moment is negative in terms of Go. The interesting thing is that we can leverage a variety of ways to reinvest the profit the DAO makes in Go to make Go grow. I do think that it's more. It will take some time. It's not a simple journey, but I do think that I consider that not expenses, but in investments. So, like the DAO is currently investing for the growth of Go, and we hopefully manage to reach like a similar level of critical mass at some point, and then we will have interesting ways of integrating what we have in Aave, what originally was the Aave protocol, with a stablecoin like Go. So in Aave v4, for example, we will have a variety of features that will integrate the Aave protocol at deeper level with with Go. So there will be soft liquidations. There will be the possibility of earning interest in Go rather than in the native stablecoin that was applied. So there are interesting things that we can do also to provide a more fulfilling opportunities for both lenders and like traditional lenders and borrowers in Aave.
Yeah, so I think the thing that everybody's looking for with stablecoins is this magical thing that is monetary premium. This is people who are willing to use your stablecoin and accept zero or close to zero yield on it. And this is where Tether is making an absolute killing in terms of the money that they make. I would posit that this ship has sailed. I think you have Tether, Circle has it to a certain degree, and DAI kind of got it a little bit. There's about 3 billion DAI that is accepting zero yield for whatever reason. I think in the increasingly competitive market, that monetary premium, like that ship has completely sailed. And so the focus right now is on who can get the best risk-adjusted yield. And to be honest, I think this is great. I mean, for users, this means that they can get access to the yields that in traditional finance. I think Martin's presentation was very awesome, where like he's talking about all these users who are these unsophisticated users, you said, who are using banks, and the banks are basically just extracting money out of them because they are putting their money in a money market fund or whatever. So this is something that I think DeFi enables. So this race to provide users with the best risk-adjusted yield should take into the TradFi risk-free rate by default, and there should be a hyper-competitive space where we're just going to completely trounce TradFi here.
I'll be the security guy in the room and complain a little bit about just when you have an ERC20 that's just slightly different than the rest, and the challenges you sometimes get with listing. With Compound, we had Comet that was basically built with very tight on the contract size limit, and then USDT comes along. It's like, okay, there's a slight change we have to make to the contract to make it accommodate. Oh no, the size limit's been hit, and it became this was going to be a plug-and-play system to ERC20 compatibility, making it a bit difficult. I am nitpicking for sure right now, but I do bring that up because sometimes you see these issues are not noticed until they actually get launched. I think most of the people here would not make those mistakes, but you do have like smaller protocols that are listing stablecoins and are very, very naive, even if they won't even sometimes read the documentation. So that's just the one thing I worry about, especially if there's also an upgrade in the future to a stablecoin. Like USDC upgraded, I think it was like maybe in February or March, and we had monitoring that detected it as it happened, and we look at it and say, okay, great, it didn't break anything. If it did break anything, we were already in trouble. And then they put out a nice article after the fact saying this is how we upgraded, which is nice, but I feel like my one nitpick is if a stablecoin provider is making an upgrade, is to forecast it ahead of time as opposed to after the fact so that people can potentially get ahead of it. But I am absolutely nitpicking around black swan events here.
Well, I'll end with one fun question for the panelists. We're all trying to make DeFi lending better. What's a very cool thing that you find about another panelist's protocol that you personally like?
I mean, so as a user of both Aave v3 and Morpho, I like different things about them. So like originally when we were, so just so people all know, so Sparkland is an Aave v3 fork. And so When we were originally looking at this project, we had Maker Core Vaults, which are the legacy CDPs, and we noticed there was some features that the market enjoyed that were not being served by Maker, which the feature that was most in demand that we weren't serving was rehypothecation of ETH. People really like getting this extra yield on their collateral. So we looked at the market and we were evaluating what was available at the time. You guys had just put, I think, Aave v3 into production. This was like summer 22, I think. And so we looked at, there was like Compound v2, there was Aave v3, and Euler was, we were looking at Euler as well. And so Aave v3, the feature that we really, really liked that you guys included was E-mode. So that, and it's proven to be the killer feature of Aave v3, where you can get high leverage, so you can use ETH as collateral and then take out USD loans, you know, the regular leverage, but then that ETH can then be used as to borrow and lever up on LSTs. So normally in Aave v2, you could only do this at the leverage that, so the LTV numbers that were also available for USD, but these same LTV numbers don't really make sense for, you know, ETH looping. So E-mode allows you to do high leverage, and I think Aave is at like 95% LTV for that. Spark runs a little bit more conservative at 93%, but it allows you to get a lot more capital efficiency for levering up on LST. So that is a feature I think you guys did a good job on.
Yep, I'd second that. OpenZeppelin was able to do the audit of V3, so we saw a lot of really interesting new features being added. I mean, this was around the same time that Compound V3 was going in a very different direction, and Aave V3 was doubling down on, no, we are going to keep the pools together, and we're going to add a lot more no features. And so I think that's really cool to see, as well as the fact that like I see both Morpho and Maker guys sometimes in the Compound forums and having discussions with folks about how different assets can be listed. So I would say generally I always see positive interactions from all three teams.
I'm going to talk about Aave before. I think borrowing premiums, or like it's the name, borrowing premiums? Liquidity premiums that essentially bring different rates for, depending on the collateral assets you have. I think it's going to unlock a lot of long-tail assets on Aave before, or at least it's my interpretation. And that was really a missing piece in Aave 3, and I'm excited by this feature.
Yeah, I'm going to talk about both these guys. So, no, I mean, I do appreciate the capability of Morpho Blue of covering some aspects that we cannot cover, or we can do, but in a way more convoluted way on Aave v3 at the moment. So for example, what Spark does with Morpho Blue and the Tina is doable on Aave v3, but it's in a convoluted way that is really not elegant. So this is something that we are planning to address with v4, certainly. There will be, we recently started creating, we will start with a Lido market. So there will be a Lido market specifically to cover specific needs of the Lido Alliance. But I think like we will be covering in a more elegant way these particular use cases with Aave v4. But that's something that is really, really interesting because I can see the value for an issuer like Maker to be able to allocate the liquidity in such a granular way and a controlled way. And from on the Maker side, what I like is the ability to segregate the collateral, because while they wanted to, but in a very isolated way, in individual walls, so per user. While in their case, some users wanted what Aave was able to do, so provide liquidity aggregation on ETH and yield on that additional yield on the rehypothecated ETH. We also have users, especially institutionals, that at the moment they don't use Aave and rather use Maker, specifically because they don't want to mix their collateral, their assets together in a pool with assets of an unproven origin, right? So that's a very important feature. We will have also in V4, we will have something like this called vaults and smart accounts that will allow users to borrow from the Aave pool. Imagine like you can borrow today from Aave v3, but using your safe wallet and keeping your collateral in your safe wallet rather than supplying to the pool and still having the capability of borrowing from Aave. This is something that's going to be supported in Aave v4. So we like to see what others do, take the best things and rework them in a way that make the most sense for us.
Awesome. Thanks for your time, guys.
Thank you.